Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team. Fortunately, Joe is not able to join us this morning, but we still have a lot to go through. And we're looking Trump in Davos giving his speech. The executive order was signed this week about institutional investors. T-bills have jumped through the roof, but rates are staying the same. Number of buyers out there, well, less than the number of sellers. So there's a lot going on in the housing market behind the scenes, and we're going to get into that today. So please sit back and welcome to the Orlando Real Estate Buzz. So a lot happening this week with housing, and a lot of it's behind the scenes. One of the things that I kind of took a look at and I wanted to go through with everybody is President Trump yesterday in his Davos speech. The media was, all this housing stuff's going to come out. And he actually had very little, maybe a couple minutes worth of housing that he hit on. And he did the standard, let's go after the institutional buyers. His number was 10%, but we know based off of surveys and other data, that's really actually only about 1.2% of the market. So I looked at that. And the other thing he said is he doesn't want us to become a nation of renters. But when you look at policy and what they're doing, and what they spend per year, the federal government spends per year, in a lot of ways, they promote being a renter through subsidies. Right now, on an annual basis, we're spending about $90 billion on housing through the federal government. That's a lot of money. And when you break it down, you've got $72 billion that comes as direct spending. That's payments to landlords, public housing agencies, and grants. $72 billion. Good portion of that is Section 8. Then they have what's called tax credits. And this is given to builders and developers to develop low-income housing, which is not ownership. It's rentals. Affordable housing is just a pseudonym for rentals. And that's something that I think we've got to address, because language means everything. And when you're trying to hide something, you change the term of something, make it sound so nice. Well, we're working on affordable housing. No, you're not. You're working on rentals. So you say on one hand, you don't want us to become a nation of renters, but on the other hand, you're subsidizing the landlords to a tune of roughly $90 billion a year. Which one is it? If you don't want us to be renters, then stop subsidizing the landlords. It's that simple. It's that simple. You've made it so convenient to become a renter in a lot of these low income situations as well, to get on Section 8 and stay on Section 8. I mean, we helped years ago manage some Section 8 homes with a investor of mine, and quite honestly, they were some of the best renters you ever wanted to have, and that was simply because they knew they didn't want to give up the subsidy. So they were, quite honestly, they were fantastic renters, probably the best you had. So, but getting back to the numbers, you look at these numbers and you just want to, you're talking out of both sides of your mouth. And that's just so typical of what happens with the government these days. Here it is, $32.4 billion in housing choice vouchers. That's Section 8. That is Section 8. And you've got project-based rental assistance, which tied to specific units. Again, you're compensating the investor for providing low-income housing. And then your tax credits, $13.5 billion in tax credits. So you can't again, you can't say one thing on one side and continue to do something on the other side. When you break down, the Section 8s, $32.4 billion a year. It does help 2.3 million households, which is fantastic. I actually just sat through the class and it was actually extremely informative. Um, Tenants pay roughly 30% of their income, and then the government subsidizes the rest. One thing I did not know is that there's really no new vouchers. To be able to get onto the voucher system now, you have to wait for someone to fall off the voucher system. But again, some of these people have been on the Section 8 voucher systems for 10, 15, 20 years. And where I didn't realize a lot of these Section 8s are helping out, which I think is fantastic, is it's a lot of older people on fixed incomes. So you've got people set on Social Security who only make, maybe 1,500, tops say 2,000 a year, or excuse me, a month. And then rents here in Orlando are averaging, on a 2 bedroom, say 2 bath, you're looking at $1,400, $1,500 a month. So how are they supposed to survive? How are they supposed to have housing? So it's a very difficult situation and trying to find a solution. But we've got to shift, I think, some of this money and some of the directives to address this and wean some of the people off the assistance. Do I have a good solution? No, I don't. No, I do not have it right now. I wish I did, but I don't. So that's something that's kind of bothered me as I look through the numbers. Is how do we solve this? Then on the 20th, the president actually came out and he signed his executive order stopping Wall Street from competing with Main Street home buyers. He's got to stop with his numbers, though. His numbers are wrong. So first off, just stop with your numbers. Get your numbers right. It's still a lot, but it's nowhere near what you're projecting it to be. And here's the thing: is as an investor, I'm not investing in real estate right now. I'm waiting for the market to correct itself again, because the average home price, here in Orlando is $450,000. When you run your numbers, you want to have, I was always taught you want to have, 1 to 1.2 on your rental fee that you're going to set. So right now you're actually below that, so it's not profitable to do rentals. It doesn't make sense. So you're not seeing the influx of the investors. If you were seeing the influx of investors, all these houses that were sitting on the market for 120, 130 days would all be eaten up. It's just common sense. They're not being eaten up because there's no investors who want them, because they're not going to pay the prices that people want, because it doesn't make financial sense from an investment point of view. And when you get into the details of what his executive order does, here's a few points. The executive order fulfills he's directed Fannie Mae and Freddie Mac to purchase $200 billion in mortgage-backed securities, which that hasn't been done yet. Basically, what they're doing is they're taking the surplus from the insurance on that Fannie and Freddie have built up, and they're going to buy the mortgage-backed securities. Is this a good idea? It's one of those, be careful what you wish for, because what happens if we have a situation where defaults start jumping again? They're required to have a 1.2% reserve, and they're well above that. Benefit I see is, well, you're going to be earning interest on those funds. That I would hope they would keep those interest payments within Fannie and Freddie, and maybe use those to help develop a new down payment assistance program for people. That's what I would suggest overall. So that came out a couple weeks ago and saw the market in the bond market do a little rally. Hasn't happened. So maybe it will give us a little rally when it actually does. Um, where is it? Analyze error savings, tax savings. Here's some of the things that I found. Instructs large institutions buying and leverage to reduce the home buyers to make Americans build wealth. Housing. It orders the federal housing programs to prioritize families, not Wall Street. Well, that's the way it's set up now. Fannie and Freddie are designed to help families. There is a limit already on how many homes that an investor can buy and use a Fannie or Freddie Mac backed loan. It's 4. You can have a maximum of 4 properties besides your primary. So there is a limit. And these investors with these billions of dollars aren't financing their homes through Freddie and Fannie. So is it going to do anything? No, it's not. It's not. It's, to me, it's a very hollow directive, because when they look at it overall, it's not going to make much of a change whatsoever. And I think they're addressing all the wrong issues on housing. And I think we've got to get back to what has actually caused all these increases. Number one was the artificial interest rates, the 2%, 3% interest rates. That's what caused it, because money was cheap, money was free. So you've inflated your balloon on these houses so large, and you're 3,000 feet in the air. You know you got to let the balloon out, but you're afraid to pop it because you know it's going to cause a crash. That's the problem. How do we fix it? Sometimes the only solution is time. And I think what we've seen, when you look overall, prices have come down a little bit. In Orlando, we lost roughly about 5% in home values over the year. No one wants to see their home equity go down unless they're buying another house. They don't mind seeing the other person's equity go down. So you can't continue to look for changes in places that aren't going to change anything. And that's what I see, is we're looking for solutions in places that don't work. I mean, there's a lot of problems out there right now. One of them is, I think it's one of the biggest ones, is the production builders out there aren't building anything anyone can afford. Nothing. When their average house is $400,000 to $500,000, that is not a starter home. Even with all the incentives that they're providing out there, they're still not affordable. They're buying down interest rates sometimes to 3.9%, 3.5%, and it's still stretching people to a 50% debt ratio. So it's not the solution. The problem is that they bought all this land during the boom, and now they got to develop it. And when you look at the development costs and what you now have to sell your houses for to keep the profits up, it makes it almost impossible for them to build houses under $300,000. I'm actually working with a small spec builder right now that we are actually building a house. It's in a more rural area of Florida, Inverness, and we're building what we consider a starter home. It's roughly about 1,100 square feet. It is a 3-bedroom, 2-bath. We're going to have nice cabinets, quartz countertops, and we're selling them for $250,000. That's what we need. We need houses in the $250,000 to $300,000 range that people can afford. And you've got to set the buyers have got to set their expectations back a little bit too. You don't need a 2,000 square foot house to start with. It's a starter home. If I can pay the same as I'm paying for rents and own the home, yeah, I'll do that. And that's what we've got to get them convinced to do. Is we've got to start showing them that, hey, you know what? You're making this, your payment is going to be roughly, say, $2,000. If you rented a 3-bedroom, 2-bath house in the same area, your rent's going to be $2,000, $2,200. Let's get you in that house. Let's start building equity. And that goes back to the 50-year mortgage that he threw out. Stupid freaking idea. Don't ever do that, because it's going to take you about, I think it's 18 and a half years, 19 years, something like that. I forgot the number exactly, before you actually start eating into your equity. So again, we're looking for the wrong solutions to a problem here that everyone wants to address, but we're beating about a bush. And until we actually admit the problems with housing, we're not going to find the solutions. And from being in real estate for as long as I have been, seeing the desire for people, there's so much frustration on buyers who want to own homes, and we're not addressing the issues. And we've got to figure a better way. Developers, the D.R. Hortons, the Lennars, these bigger builders, they've got to start maybe eating up a little bit. And maybe that's how we change some of the funding that's going on, in that if we address them and say, hey, we know you paid so much money for this. On average, you've got to build a $400,000 house or a $450,000 house in this development in order to make a profit. Maybe we do have to subsidize them in that area. Hey, if you're going to build homes from, say, 1,200 to 1,500 square feet, keep the prices between, $250,000 to $300,000 in this area. Then what we'll do is we're going to actually help you through tax credits, maybe special down payment assistance programs for that development. But you're going to have to keep things here. Maybe that's what we have to do. We were spending $90 billion and it's not working. It is not working. So we've got to look at different solutions. And we've got to start talking about them and not just coming up with lame brain, 2-minute headlines. I'm tired of that. I'm tired of it. So this is what happens when Joe's not here. I tend to go off a little bit more. So anyways, I just wanted to go through that because what's going on right now here in the Orlando market. Anyways, Redfin came out with some numbers on buyer's market versus seller's market, and the number of buyers that are available versus the number of sellers. And right now, Orlando is one of the biggest buyer's market. They're saying there's roughly 57% more sellers than there are buyers, which is absolutely nuts. I'm not sure where they're coming up with their numbers. That I got to figure out. But they're saying there's roughly only 11,000 buyers in the Orlando market right now, but there's roughly about 18,000 sellers. So where that number's coming up from, got to figure that one out. Not sure exactly. So, but when you look overall, these are numbers that Redfin came out with this week, and you can see the gap that we have. We've got roughly about 2 million sellers out there nationally and only about 1.3 million buyers. Those numbers could be coming from listings and also mortgage applications. So that's something we can look at. Then one of the other big things that happened this week is we saw our Treasury bills, the 10-year T, which we always tell you that's what you want to watch in order to see where the mortgage market is going. They did a huge $654 billion Treasury auction this past week, and that spiked rates. And we've seen the 10-year Treasury right now jump up to 4.26%. Just last week, we were sitting down at 4.15. So we've seen over a tenth of a point increase in the yield on the 10-year. Normally, you would see rates spike quite a bit. But the good thing out of everything that's happened this week is that our margins between the 10-year Treasury and the 30-year mortgage has shrunk tremendously. Remember last year we were telling you that rates, the margin was sitting roughly about 2.5%. You can see here 2024, and you can see here 2025. At the end of 2025, that margin between the 10-year T and the 30-year mortgage started to drop, which was helping to bring rates down. And then here, the beginning of this year, we've seen it actually drop under 2%. It was sitting roughly about 1.88 the other day. And as long as this margin continues to shrink, it's going to help keep rates down. So instead of seeing rates jump back up where we would have here to roughly, say, about 6.75, 6.8, we're actually holding on the rates at roughly about 6.2. So that's something as a buyer you've got to be aware of, because this margin can start pushing back up at any time. So think about that when you're looking to buy, knowing that, hey, the mortgage margin right now has shrunk and it's to my advantage. And I'm hoping that we see this continue to get back down to a normal rate, which is roughly about 1.5. If we can get that down to 1.5, then we're going to stay steady at the 6% mortgage rate for the year. We do that, it's going to help everybody out. So that's something that we're watching very, very closely. So when you look at all this and we look at our numbers, we're going to look at our numbers here for Orlando. As a seller, you've got to really realize how the market's sitting right now, how tight it is, and look at the houses that have been on the market for a while, because a lot of these are just overpriced. Something that I'm doing now with all of my sellers is right before we're ready to list, we're going out and we're looking at all these houses. We're probably looking at 3 or 4 of the houses in the neighborhood and the surrounding neighborhoods that are roughly, that an appraiser would use as a comp. And we're walking through them to see the differences, to see, how updated is it? What work does it need? How does ours match up to this? And it's really opening the eyes of our sellers. And I think it's allowing them to sit back and realize, okay, my house has updates, but I see why they're sitting. I think I can go here with my price as opposed to going here. And it's helping to move the houses that we're listing quicker than what's the average days on market. We were fortunate enough to do that with one in Rosemont. And instead of taking on average 45 days, which it was in that area, we were able to get under contract in 6 days. So knowing your numbers, knowing the market, you've got to stay on top of this, whether you're a seller or you're a buyer. For a buyer, it's how it helps you negotiate. For a seller, it helps you realize what the real value of your home is and what the market is looking for out there. So getting into our Orlando numbers, it wasn't too bad of a week. It was nothing great. We had 337, single family home sales. First week of January, that's okay. We can live with that. Our inventory is starting to go back up. So we're back above that 8,000 mark. And I expect this over the next 2 or 3 months, especially going into the spring season, early March, early April, we'll start seeing this continue increase. But as a seller, I want to get my house on earlier. I'd like to, if I'm selling it, I'd like to get it on by mid-February so that I'm the first ones on the market. And if I've got it priced right, those early buyers, I can take advantage of those. Condos are condos. We'll just leave those alone. But this was interesting because we always look on a weekly basis. One of the big things we always look at is our original list to sales price. And look at this. for the first week of January, we actually dropped below 90%. So sellers, the ones who didn't take their properties off the market, were willing to cut their prices dramatically to get these houses sold. Look at this, under 250 to 84%, under 250 to 300K, 87.9%, 300 to 400, 93%. And look at this in over 1 million, 78%. I do a lot of those draw inspections, and I can't tell you how many houses I see going up, spec houses in Winter Park, that are honestly over $2 million. And I'm sitting there, if I'm one of the builders, nervous as heck, because there's a lot of competition, a lot of houses being knocked down, a lot of new houses being built, and you're competing against these things. It wouldn't be my cup of tea. I wouldn't sleep at night. Then again, when we look at it graphically, we see here our sales are sitting well below that 400 mark. We really need to get back up to that 500, 550 mark here in the Orlando area, based on our population and the number of houses. And then inventory, you see in November where it started to drop off, and here January, which it does every year, we start seeing it increase. We'd love to get this back up to about 9,000, 9,500 for the buyers. Sellers, it means you're going to have to tighten your belt a little bit, but I'm hoping additional inventory will help bring in some additional buyers. Then this is something I have been keeping an eye on for a long time now, is the withdrawn. And you can see here, the number withdrawn is still staying high. Past 2 weeks, it's roughly just over 300 homes have been withdrawn from the market. So these are sellers who have just gotten frustrated, not getting showings, not seeing any movement, but they're also not willing to drop their prices. So at some point, I think sellers are got to start realizing it's not 2021 anymore. And that's just a tough thing for a lot of them to swallow. So those are our numbers. That's what's going on this week in real estate. Thank you for joining us. And please like, subscribe, and join us every week on the Orlando Real Estate Buzz. Thank you so much. God bless. Have a wonderful rest of your week. Bye-bye.